This episode of Stock Club is brought to you by Hyundai. Restart your journey towards a greener world with Hyundai's next generation of zero-emission cars. Find out more about their range of electric vehicles and the savings they can bring to your company and employees at Hyundai.ie. Hi there and welcome to the Stock Club podcast. I'm James, and with me this week is MyWallSt co-founder and chief investor Emmett Savage and our head analyst Rory Carron. In this episode, we're talking about Zoom's incredible quarter and if the company is too expensive at today's prices, 3 stocks that have been beaten down by COVID-19 and the road to recovery for them, and an exclusive interview where we learn how the game of poker can make us all better investors. So, guys, I don't think we can start today's podcast without first talking about Zoom. The video conferencing company reported on its second quarter earnings earlier this week, and it was really something to behold. Here are just some of the key numbers to lead us into this conversation that came from Zoom's call. So revenue in the quarter jumped 355% to hit $663 million for the quarter. Compare that to 2 years ago, that's a 9-fold increase in revenue for Zoom. Free cash flow increased 22-fold in the quarter to $373 million. Gross margins increased from 69.5% to 72.3%. The number of customers paying over $100,000 a year doubled. Overall, they recorded 148.4 million monthly active users in the quarter, which is up 4,700% year over year. They were just some of the big figures I grabbed. Rory, I'm going to come to you first. I assume you're going to say that you predicted all of this when you picked Zoom for the MyWallSt shortlist back in January.
Yeah, of course I did. No, I mean, look, when we added Zoom, it was pre-COVID. It was pre-COVID in the Western world anyway. The first report should have come out in China, but it certainly wasn't the issue that people thought it was what it's become. Those numbers, as you list them off, James, it's standing. I don't think I've ever seen revenue figures, growth figures at all like that. Certainly not from a company of Zoom's size.
Yeah, and they weren't coming off a low base. Like they were doing pretty well this time last year too.
No, not at all. It's certainly not what they used to call a soft comparable. You know, they were up 95% in revenue in the same period last year. And like, yeah, some of the metrics are incredible. You know, they've nearly 1,000 enterprise customers now paying them over $100,000 a year. They've 370,000 customers with more than 10 employees. That's gone up 5-fold in a year. And even, you know, looking at guidance, it was way above what the consensus estimate was, but I still think that they're actually underplaying it. And I understand why they are, because it's sensible to underpromise and overdeliver anyway, let alone with the kind of macroeconomic uncertainties that we're facing at the moment. And it's just been the most remarkable story for them over the last year now. You know, now you have to start talking about valuation. We talked about valuation in January. It's up over 450% since we added it. You know, price to earnings isn't really an appropriate metric for a company growing at this rate, but just to put it out there, their price to earnings as we record this is 1,820.
So what does that mean exactly? The price to earnings being that?
Price to earnings is the amount you're paying, the market cap of the value as a ratio of the profit it's generating on the bottom line. But of course, like, you know, we don't like that metric for hyper growth companies because that metric can change so quickly. And when you're in hyper growth mode, you're obviously investing a huge amount in the business. So your earnings at the bottom line can fluctuate really rapidly depending on how much investment you're putting in, depending on how much you're spending on R&D and marketing and stuff like that. So it's not a good metric for a company like Zoom. Price to sales is another metric that we use for kind of high growth companies. That's at 115. I remember saying maybe it was a year ago, I was looking at like Viva Systems with a price to earnings of 18 and thinking, you know, well, that's the premium you pay for a premium company. So it's really like, but then like, how do you figure a price to sales on a company that's growing revenues at the rate it's growing at? You know, it's whatever figure you land, that's going to be unrealistic. It's just, you know.
Well, let's put that into a bit of context in a different way. So as we're recording now, Zoom's market cap is in and around $130 billion. To put that into context, this 9-year-old company is now worth more than IBM, and it's more than 6 times the valuation of its workplace collaboration comrade Slack. Do Zoom and Slack not even live on the same levels anymore?
Well, I would argue that they do, but perhaps there's a longer sales cycle for something like Slack.
Yeah.
The reason that Zoom has exploded in growth is because this pandemic hit us all as a massive shock, and the very first thing companies needed, the very first thing people needed in general, was a way to communicate, and a way that was better than your typical voice call. And you think about, people talk about Zoom as disrupting the telecommunications sphere. Talk about the business travel sphere. Last year it's estimated there were 405 million business trips taken just by US workers. Zoom is now your business travel. That's how you communicate with your partners, and how you do deals overseas, or with companies that are not in the same locality as you. And consider this as well. This is one of the most amazing things. Zoom is a subscription-based business. Yet at the moment, new customers are contributing more to revenue than existing customers were. And usually with a subscription business, the majority of your revenue is coming from the customers you signed over the previous years that are renewing their subscriptions, or potentially spending more as they deploy their solutions into new business segments of the business. At the moment, it's the new sales that are actually contributing more to that revenue line. And that's insane. You don't see that a lot in these kind of software companies. The big question that you have for Zoom now is, do they have a sustainable competitive advantage over the very long term? And, we use Zoom because it's the best solution we found. And I think an awful lot of businesses have found that too. But there was a best solution before Zoom. Zoom is a young company. It's not been around very long. So will there be a better solution down the line, or will there be a solution that's comparable to Zoom at a much lower cost, or with a better distribution network, let's say like a Microsoft or a Cisco? It's, part of Zoom's appeal is that it's really easy to set up, especially for smaller businesses. I don't see a huge amount in terms of switching costs. For larger businesses, yes, there's a learning curve and an deployment element that will take larger customers will think kind of long and hard about switching to another provider. But, for us, it's so easy to set up a Zoom account and get started. And other businesses are going to adopt that model. And now when they start rolling out complementary offerings like Zoom Phone, for example, which they just recently released, you will see those switching costs crystallize. But, what keeps companies loyal to a software solution, a lot of the times is operational risk as well. So you think about things like data loss. That's not really an issue with Zoom. You're not going to lose all your data if you switch to a competitor. Yeah. And I've seen an awful lot of people talking on Twitter about the network effects. I don't think Zoom has network effects. It's anyone can open it. If you send a Zoom link to someone, they can talk to you. You don't need the other person to have an account. So the value creation in everyone having an account isn't really there. So there is an awful lot of questions on it.
Just on that point, Rory, do you think that's somewhere where Zoom might be at risk from the likes of Microsoft Teams? Is the first company that comes to mind there, who have an incredible network and many different products where they can kind of get easier into your life and take full advantage of that network effect?
Teleconferencing has been around for so long. We know there's so many opportunities out there for companies to come in and with a viable offering. It's not difficult technology. It's just that Zoom does it better than anyone else. And like I said, that doesn't mean they're going to be doing it better than everyone else forever. Although they do, as you said, now have a massive cash pile to reinvest in that business and keep developing this product. But yeah, I mean, the valuation at the moment is somewhere that I think a lot of investors would feel uncomfortable, and we'll have to see how it plays out. But you are paying up for what is an incredible business with an incredible story, a brilliant product, a fantastic CEO who seems to really know the industry. I saw this tidbit about him where when he left Cisco to develop Zoom, 40 out of the 80 engineers that he was working with all instantly joined him. That's a guy who clearly commands incredible admiration from his peer group, and people clearly believe in this guy's vision and his product innovation. And he still owns a massive share of the company. That's always something we like to see. So look, there's a lot of it checks a huge amount of boxes in terms of a company you want to own shares in. But seeing a company go 45%, a company that size go 45% in one day would make any investor nervous, I think.
Yeah. So what will you be looking out for over the next few months in terms of Zoom? You mentioned that cash pile. Are you going to be, what would you like to see them do? Reinvest that money and kind of build complementary product offerings?
Yeah, we want to see some cross-sell among the larger customers, definitely. We really want to see that large customer number expand. We don't know yet. It's so hard to talk about the work from home stocks in terms of we don't know how long this is going to be going on. Even us as a business, we had, was it September 13th as a back to work date. That's certainly not happening. And this is, and we're talking about Ireland, where we have very low case numbers, very low death rates. You know, this is going to keep going for quite a while, potentially until a vaccine is found, which is, you know, the unknown is the X factor in this entire scenario. Yeah. So how many of these big businesses are going to make that switch? What's the numbers we're going to be looking at this time next year in terms of customers that are spending over $100,000 a year with Zoom? These are all questions that we have. You could throw them into a model, but it's going to break any model you put it into, because there's so many things moving at this moment that we just can't figure it. You know, so, I mean, they beat their consensus estimates just there by 165 million or something. You know, no one on Wall Street had a clue what was going to happen. Like, no one guessed it. So, yeah, it's really one of those kind of roller coaster shocks. You're going to get on. You just better get ready for the ride.
Well, this is the last question I'm going to ask about Zoom, and we'll move on. It's for you, Rory, and Emmett. At today's price, would you buy Zoom? One word answer will do.
I'd invest accordingly. That is what I do. I mean, like, I love the business, and I'd love to buy shares in the business. I wouldn't buy a lot of shares in the business at this price point. That's what I'd say. I'd edge into it.
Dip your toe in, maybe. Emmett?
Yeah, I'm the same. I mean, it's highly future relevant. I just see what I believe to be better opportunities out there at the moment. But I do think Zoom now, it's going to keep its lead against all the other substitutes. I hope it has the sense to innovate appropriately and perhaps do a couple of sensible acquisitions, but don't lose themselves in their, in their newfound wealth. Yeah, but I would buy some Zoom, but I would not buy a full position.
Okay, cool. Let's move on then. So in the last episode of Stock Club, we talked about some of the companies that had thrived under the full effect of lockdown restrictions, like Home Depot and Sea Limited. This week, we're going to go to the other end of the spectrum and look at those companies that really suffered during Q2 in lockdown. Rory, I'm going to come to you first here. One of the companies we want to look at first is Ctrip, who are currently down about 20% since the start of the year. I assume this is for obvious reasons.
Not entirely, actually. So Ctrip's now called Trip.com. With a new ticker symbol, which always annoys me because it messes up all my my spreadsheets. But this, like, Ctrip/Trip.com was a company that was sold to investors for many years as the Booking.com of China. And in many ways it is. You know, when we first added to the MyWallSt showroom, we were seeing an awful lot of positives in terms of not just like steady high revenue growth, but also in terms of expansion into new sectors and new geographies. And it had recently struck a deal with Baidu, which is often called the Google of China, to effectively take control of its biggest rival in the space. And a lot of what we were banking on was that this company had a huge opportunity ahead of it, which it still does. Like, it's estimated only about 10% of the Chinese population travels abroad, and yet it's still one of the largest travel industries in the world. And it just has massive market share. You know, it's a huge inventory of options across everything from hotel bookings to air and train tickets to bus tickets, even to package tours to car rentals, pretty much anything to do with the travel space. Trip.com is there and has like a market leading advantage. They've anywhere from 200 million to 400 million monthly active users, of huge database of reviews. Our report in 2018 showed they had 53% control of all online travel, 60% share of all online accommodation, 5% share of all online ticketing. So like, these are the kind of numbers you think like, wow, massive opportunity, massive market share. What could go wrong? However, the business story, definitely from an investor's point of view, has become so convoluted. You know, I could spend the whole podcast talking about this company and probably bore everyone to death, but they essentially have every single finger in every single pie, and with so many different terms. You know, like, they own 38% of Elong, they own 45% voting interest in Qunar, Baidu owns 19% of them. They have an online business affiliate whose name I won't even try to pronounce. They're the largest shareholder in an Indian online travel company called Make My Trip. And this kind of signifies the scale of what we're talking about in China. You know, we discussed many times, it's a very, very big country, a very big market. They don't talk about cities. You know, they talk about tier 1 cities and tier 2 cities and tier 3 cities, because there's just so many of them that they have to break them up into these kind of smaller subcategories. And the two things that this does, this kind of convoluted story means that they seem to constantly be in this transition period. They're always trying to align the various interests together and get the whole thing working together as a unit. And it also just makes it hard for investors to understand the long-term story going forward. And, there's so many times I approach this business with trying to kind of figure out what's going on with them, and you just throw your hands up in frustration, going like, "What have you done now? Where is the business going now?" In terms of COVID-19,
that's an important point to make, Rory. That like if you don't understand the core trajectory of a business, it's very hard to believe in them enough to invest long term.
Yeah, it's very hard to get a clear sense of where the business is heading. But even as someone who's studying the business, they themselves seem to have a tough time in explaining, where this is eventually going to lead.
Yeah.
And, in terms of COVID-19, obviously that was going to have a negative impact on them. China handled the virus very well in terms of domestic outbreaks, but worldwide acceleration means there's very strict travel restrictions in place at the moment. Pretty much no foreigners are getting into China. There's a 14-day quarantine on all nationals re-entering. And that's going to hurt. That is going to hurt Trip.com. 30 to 40% of their revenue comes from international travel. Their net revenues for the last quarter fell 42%. They're expecting an even steeper decline in the coming quarter. They're guiding from anywhere between 67 and 77% decrease in revenues, which is tough for any business to handle. They are an aggregator, so they don't have the kind of massive capex cost that someone like a cruise line would have to deal with. At the same time, right, you look at a company like Booking Group, for example, they're valued at $80 billion. Trip at the moment is valued at $18 billion. Booking's definitely a better run business. The market that they're operating in is a more profitable market. But where's the bigger growth opportunity over the long term? If you've got a very, very long-term horizon, Trip.com could be a very good investment because there is so much room for them to expand compared to their Western peers.
But not out of the woods yet.
No, certainly not out of the woods yet. They've got an awful lot of restructuring, getting that business back in terms of making the whole thing work as a unit, making the whole thing that it's not just, spray and pray everywhere and hope that they hit a big one somewhere. That would be my take on the company at the moment.
Cool, thanks for that. So, Emmett, I'm going to come to you then, and we're talking about Eventbrite. So, Eventbrite was obviously hammered by the cancellation of pretty much all live gigs and events and just fun in general over the past few months. And the stock is down about 50% year to date. Do you see any way back for Eventbrite at the moment?
Yeah, Eventbrite is a business I want to like as a result of it being one of the very few B2C software companies that has a giant brand and has not had a 2 or 3 or 4x run in the last year. And as you say, it has very obvious headwinds, and you could argue the absolute opposite of effect of what happened Zoom. So Eventbrite, as you say, it floated about 2 years ago. It kind of had the very first short-term run-up and it kind of hit a high just soon after flotation of about $37 a share, and it's in total down 70% since then. And as you rightfully said, James, it's down a further 50%, or it's down 50% rather in the last year. So it's a company that's $11 a share. Its market cap is virtually $1 billion on the nose, and it does have quite a lot of, I think, mind space occupancy in investors because they know the brand, they've seen the product, they see its cheap, quote unquote. But as you said, the real question is, can it grow? Can it grow back to its post IPO price, $37 and beyond? And that is the real question. Before the pandemic, what is particularly interesting to me about Eventbrite is that it was starting to slow anyway. 2017 revenue growth was 51%. 2018 revenue growth was 45%, and 2019 revenue growth came in at 12%. So, the trajectory that we are looking for, even had coronavirus not happened, wasn't necessarily there. Now, the business is actually structured now to survive. After they pay off all debt, they have something like $350 or $360 million in cash. Right now today it costs about 34 million per quarter to run the business. So simply it has 10 quarters left in the tank as things are today. But they are also engaging in some significant cost cutting, which they say is going to take 100 million out of the business every year. And by Q4 they'll have reduced expenses to that effect. So the business is definitely structured to survive from a financial perspective for several years, which is what you'd want, really, because none of us know where the virus is going. We all certainly have hopes and aspirations and dreams of going on a cruise or holiday next year, but there's still, we can't bank on that. So Eventbrite will survive, but that doesn't necessarily mean it's a good investment. They recently formed a partnership of sorts with Facebook. Ticketing on Facebook, and it looks like a pretty good deal, and it allows customers to buy tickets on the Facebook platform, but it does beg the question, if Facebook are looking over their shoulder and seeing traction on this add-on, they'll just go and do it themselves, I would presume. I mean, why would they share any revenue or share value rather with a third party? So while it's good, I wouldn't get comfortable that they've done a partnership with Facebook, but certainly they said something to Facebook that was convincing enough for that kind of integration. Really their growth now is coming from free events, and I guess that's good insofar as it is growth. It's keeping their platform and brand alive. I attended an Eventbrite online event this morning, and it went very well, and so far as my user experience was good. But really an investment in Eventbrite today at circa $11 a share, on the blind anticipation that will get back up to its IPO price, isn't very well thought out. But what I would say, and the way I'd conclude, is that business to consumer brands that are well known have a habit of surviving and growing again. And there's barely been an example of a stock that's B2C that in its absolute trough of disillusionment and despair, where I decided that's it, it's done, game over, has it not risen again. Like, it's very rare to see a B2C actually go kaput. So, and taking that as, I suppose, a hand-waving macro argument, you could say, Eventbrite will eventually get there. It has a few years of survival in the tanks, and when coronavirus passes, you can only expect them to fill the sales again, and for them to survive and grow.
A big if and when, though.
Yeah, a big if and when.
Yeah, absolutely. So the last company I want to come to then is Vail Resorts. This is a stock that we actually expected to be more affected than it currently is, down just a little over 12% since January. Why is a company that depends so much on travel and vacations recovered so well, Rory?
Well, I mean, it got hit very hard at the start. So, we talk about travel, in terms of C-Trip being affected or Trip.com being affected, entertainment in terms of Eventbrite being affected. Vail is a mixture of entertainment and a travel stock. It's the biggest ski resort operator in the world. It closed all its North America resorts midway through March, and it basically went into emergency mode. Like, the management paused their dividend for at least 2 quarters. They took out $600 million in debt. They cut CapEx spending. They cut corporate salaries. They furloughed workers. And in a way, it did really help soften the blow in this company, because they pushed the button right away. They were early and made sure they had cash available to weather this storm. And I think that gave investors quite a lot of confidence in the business. Obviously, they were affected. The results were affected in the quarter that ended April 30th. They saw revenue fall about 27%, which actually wasn't too bad. The first half of the quarter was not very badly affected. They still managed to post a profit of 152 million, even though that was down by 50% from the year before. They've also offered credits to customers with season passes for the next year, and that's going to eat into revenue. But again, I'm happy they did this. This is management thinking long term. They're not letting the stock price dictate their behavior. They're building that loyalty with their customers. And, going forward, they've opened up their parks for summer activities, which include kind of like mountain climbing, hikes, biking. It's never, the summer activities are never going to make up for lost experience in the ski season. But, with people not being able to travel abroad and the fact that it's all outdoors, they may get some business from it. The problem is, of course, these places are rarely close to major metro areas. You usually have to fly there, which people aren't doing at the moment either. the fact that the height of the pandemic is coming in their off season is probably fortuitous. But then again, look, we keep coming back to this. We still don't know how long this is going to be on for. The spread across America is still high. You're talking about 40,000 cases a day. So yeah, what's going to happen when ski season starts? If we're still in this crisis, are people going to want to go skiing? Are they going to see it as an option to be outdoors and not have to travel abroad? That's the other side of the coin.
True,
but it's really going to depend on what level of fear there is out there, what level of restrictions there are in terms of where people can go. No one wants to go on a ski holiday when they can't dine in the nice restaurant or drink in the chalet. It's all dependent on where we are with this pandemic, and so that's why I think it's great that they did take those emergency measures early. It's a stock I've admired for an awful long time. I think it was a stock of the month not too long ago.
Yeah.
Look, it could be a buying opportunity long term. I think Vail is always a good buying opportunity. Those mountains aren't going anywhere anytime soon. So yeah, interesting company, interesting time for it. Another pullback would be great because, as you said, it has recovered quite substantially from that big drop it saw in February.
That's an interesting thing about Vail, and it's what I think Peter Lynch calls it hidden assets. You forget about the actual mountains they're built on.
Yeah, I think he had 7 categories of stocks. I'm sure listeners will correct me. It was either 5 or 7, and hidden assets were the hardest to spot and value. But he definitely, I think Vail is a very good example of that. Nina Paper was another one. It was a paper mills a few years ago, and it totally there was no recognition in its share price of the fact that it owned hundreds of thousands of acres of forestry that it was using to make paper.
Yeah.
The business was only valued of the tons of paper that came out the front door. And when I look at Vail Resorts, it kind of reminds me a little bit of Nina Paper and a lot of other businesses. And that hidden asset may never be reflected in the share price, which is something we just have to deal with.
Absolutely. Thanks for that. So let's move on and take a look at some of the things going on in MyWallSt at the moment. We're at the start of a new month, so that means that members of the MyWallSt community have lots of exciting things to look forward to over the next few weeks. Our Stock of the Month selection is due to go live on Monday, September the 7th. This pick will join a list of stocks that have returned an average of 144% since we started picking them in 2016. Make sure you don't miss out on that new edition. We'll also be recording a new episode of the Stock of the Month podcast over the coming weeks, as well as adding a brand new stock to the MyWallSt shortlist. Members of the MyWallSt community will get access to all of this great stuff and more as soon as they're published. If you're not a member yet, you can sign up for a free trial now by just clicking on the link in the notes for today's show. This is the part of the show, guys, where we usually go to Jargon Busters, but today instead we have a special treat for you guys. Earlier I had a chat with David O'Donovan, who's the chief editor with our friends over at NOAA. In this interview with David, we chat about his experiences working for one of the largest market-making firms in the world and lessons that we as investors can learn from the game of poker. Enjoy. So I'm joined here today by David O'Donovan, the chief editor for our friends over at NOAA. Welcome to Stock Club, David. How does it feel to be the very first guest on Stock Club?
Thanks, James. Yeah, feels great. I'm a big fan of what you and the team are doing, and really enjoyed listening to the podcast over the last few weeks. So yeah, keen to be a participant. I hope I can just be as knowledgeable and add as much value to the listening experience as you guys do.
I should probably point out that I actually didn't ask you to say that in the prep for the show. So we're going to talk a little bit more about the ways in which MyWallSt and NOAA are collaborating later on. But I first want to talk about some of your own experience with investing in the US stock market. Before you joined NOAA, you worked as a risk analyst at the private market making firm Susquehanna. Just for listeners that aren't aware, can you briefly explain what a market maker is and what Susquehanna do specifically?
So Susquehanna's main role, it would be one of a market maker. So the best way to describe a market maker is that they are a person or an entity that facilitate the everyday trading on an exchange. So when you go to an exchange to buy or sell a security, you'll see prices. You'll see a price that you can buy or sell securities at. And behind those prices, an entity exists, and that entity is typically a market maker.
Yeah.
Without them, you pretty much wouldn't have a fully functioning or efficient exchange. So essentially, if you think about If you think about the classic image of stock exchanges that you see on the news, and you see all these prices up on a big board, and they're constantly showing what people can buy and sell securities for. If you didn't have market makers, that screen would be very spotty. Like you'd have occasional prices in different places, but it wouldn't be a continuous flow of prices. Every security wouldn't have a clear indicative price of what you could buy and sell. So basically, the market maker in that case is providing that opportunity for you to be able to buy and sell at what they would consider a reasonable price.
So market makers kind of provide the liquidity to the market in some way.
They do. They help in a massive way there, and I guess that's what they see as their vital service. And they work quite closely with exchanges, and they're quite a vital partner to exchanges because they help that exchange exist. Another just way to think about it as well is in kind of more layman terms is they're kind of like a sports bookie.
Okay.
So your kind of Paddy Power example for Irish and UK listeners, and or even more so even like a car dealer. Like they're an entity that you go to with either the desire to buy or sell something, and they stand in the middle, and they're willing to take the risk involved in that transaction. Cool.
So let's talk about Susquehanna then specifically. What function or what space in the market did they occupy, and what did they do?
Yeah, so SIG, so Susquehanna, their acronym, their main acronym was Susquehanna International Group, and I guess SIG just became the more easy term to go by for their name. So SIG, their main role would have been actually with derivatives. So that's how they initially made their name. That's how they initially, I suppose, established themselves in the market, and in particular, trading options. Yeah. So options, I suppose, very quickly for people not too familiar with it, what that security is an instrument which allows you to purchase the option to buy or sell a security, an equity, for example, at a particular point in time and at a particular price in the future. Yeah. So they started off with those, and they became a massive market maker in the US, expanded internationally. Then as ETFs became a major financial security, SIG were actually a big player behind those. They started to market make those as well. So that then evolves to be their two main assets. But outside of options and ETFs, where they hold pretty strong market positions, they also trade in a variety of other securities, everything from commodities to cryptocurrencies to even actually more recently, and they've actually moved into sports trading as well. Okay, so wow. Quite a diverse book, but the main focus would be options and ETFs.
Cool. So in your time at Susquehanna, in their role as a market maker, I imagine reacting to news and new events is very, very important. Can you tell us a little bit more about how quickly a firm like Susquehanna can react to market news as it comes out?
Yeah, so this is interesting. So for my role as a risk analyst, I wasn't actually in a position where I was executing any trades myself. But what I would have been doing is seeing how quickly traders would react, because the items that I would be analysing the risk on, like different positions that they held or different trades that they were executing, I would see pretty much in real time how they impacted on the overall capital that the firm had basically invested or had put at risk in the market. And I would pretty much be, sitting monitoring various positions, and oftentimes before even news became apparent, before you'd have the news announcement of a major development coming on one of the screens in the office from Bloomberg, or before you'd even hear something over one of the hoots. So one of the hoots would have been the kind of intercoms that were throughout the office, making announcements on big news. Before you even hear those, you'd start to see prices move. And it was quite interesting because I guess in that trading environment, sounds are used quite a lot. So every trader would have their own sounds to basically indicate and to bring their attention to certain developments, usually around a price. So if a price moved in a particular direction, they'd get an alert. So some of the traders got quite creative with their sounds as well. So it's quite interesting when things really kicked off. You just hear a lot of different sort of jingles and bells and roaring and shouting. So what I found amazing was just how in that position, how quickly prices would move with the news, and even some cases before the news was actually properly disseminated, like actually, and by disseminated I mean out to the masses. Like so it's a case that I suppose the first person to get the news has already started reacting to it. By the time that hits Susquehanna, it's probably seconds later, maybe even milliseconds later. But then by the time it hits Bloomberg, by the time it hits you and I, but by the time it hits a push notification on our phone, we're often lagging quite a bit. So that was quite an insightful experience for myself, just to see how quick things react.
It's fascinating, and I think it's something that's become relevant, especially in the recent market. You know, I think of pharmaceutical companies recently and the kind of race to find a vaccine for the coronavirus, COVID-19, and you know, you've seen a lot of them boom and drop based on news about, you know, potential vaccine or potential funding and stuff like that. From what you're telling me, by the time we get that push notification on our phone, it's already too late. The moves have been made. The market has moved in terms of that. For the ordinary retail investor then, you know, if we're kind of putting forth the position that by the time you hear the news, it's already too late to invest, what kind of advice would you give when they're competing against these giant market-making firms?
Yeah. So that's a really important question, I guess, for people to ask themselves is like when they set out to participate in financial markets, like what kind of participant do they really want to be? Do they want to compete with someone like a Susquehanna of this world, or do they need to take a different approach? And maybe even before answering your question directly, I suppose I'll touch upon just to give a deeper sense of some of the advantages that a company like SIG would have, even let alone the news that we're seeing, but also the prices that we see. So when you go into trading apps, they have come on leaps and bounds over the last 10 years to give you quick, accurate and meaningful prices. But it's still a case that your standard broker, your standard trading app won't necessarily be able to actually present prices to you at the same speed that they would to, or at least they wouldn't present prices at the same speed that Susquehanna would have access to prices. Yeah. And that's just because, I guess, they have their own internal systems that prices need to flow through. They have their own risk metrics that they need to run prices through before they offer them to you and I as customers. So even just from executing the trade to actually see a price that's meaningful, oftentimes brokers can lag. And one way you might see this is that if you are really quick to react to a news or react to a news development, sometimes your broker wouldn't even be able to facilitate it in that instance.
Wow, okay.
Because they themselves would have to catch up. Now it all depends on exactly how what platform you're using and what access you paid for. But typically
for an ordinary retail investor, it would be a standard brokerage account, online brokerage account. So it's not just the flow of information coming to you, but it's actually your ability to react to that information. You're already at a disadvantage.
Exactly. Yeah. And it's for good reason as well, because what's happening in the whole industry really is it's an absolute arms race for speed. Yeah. And the companies like SIG, they have built up the capital, been successful throughout the years to be able to take tens of millions, if not hundreds of millions of dollars, and put it into infrastructure and technology that you and I just have no chance of accessing without paying through the nose for. So like they're using technology that is mind-boggling, like fiber optic cables under the Atlantic to microwaves sending messages between the US and Europe, to buying prime locations next to exchanges to house servers that allow them to facilitate prices. It's just it's mind-boggling how much of an arms race it is for speed here. And Flash Boys is quite a often cited example of the race between financial firms to get orders into exchanges. I remember coming across a report, I think it was about 18 months ago now, talking about how speeds, even since that book was written, have increased 60-fold.
Wow. That's incredible.
So it was already at milliseconds. Yeah. So now it's gone down even smaller again. So that's just kind of reinforce that point that speed, you just don't stand a chance really. So to kind of focus on what you can do as an individual investor, what I would say is you need to find that edge, you need to find that advantage, or at least that common playing field that you can exist on. And I think what you need to look at is what over time can you factor into your decision making that allows you to level that field. And I think knowledge is by the way that the most prominent thing that comes to mind is actually taking in news, allowing it to digest, allowing it to kind of to be considered for a few days, analyze it, do your due diligence on an investment, and play to your second advantage, which is, most of us at least, we can take a long-term perspective on things. We're able to be satisfied by taking months to years to decades perspective if we're trying to build wealth. So playing to those two advantages means you don't have to rush, you don't have to participate in that speed race. You can sit back, and yes, you might miss out on some opportunities to profit, but your odds of profiting in that playing field at the moment are so low that you're probably best sitting that one out and putting the probability more in your favor by looking at the knowledge aspect.
I think that's a very interesting point you made there as well, is that, as an individual retail investor, the only person you have to answer to is yourself. So if you don't, hit a certain return in a certain year, you're not going to lose your job. You're not trying to make these short-term returns. You can take a much longer approach to how your portfolio performs. Just before this call, I was reading up a bit about Susquehanna, and I read a great article about its kind of foundation and its genesis, and it was actually founded by 6 college friends who realised that their skills from poker games they played could help them in making probability-based decisions on the market. One of the co-founders of Susquehanna, Jeff Yass, actually said, and I quote, "The basic concept that applies to both poker and option trading is that the primary object is not winning the most hands, but rather maximising your gains." I think that's a very interesting comparison to make between poker and investing. How fundamental is the game of poker to the culture of Susquehanna?
Yeah, it's pretty key. So I suppose how practically it applies day in, day out varies depending on what kind of trading desk you're on. But the core values and the core skills that you develop from participating and playing poker can be seen throughout the firm. So they want people to understand first and foremost that you cannot win every hand. You cannot sit down and expect to win every hand. You have to basically look for an advantage that just tips the odds in your favor. You have to be able to look for that edge that allows you to win more often than your competitor. So you're not looking to win every time. You're looking to win. You're looking to win more often. That's the goal here. And that's the same with a poker player. Like, no poker player can sit down and expect to win every hand. That would be the luckiest person absolutely on the planet. Like, you need to understand that and factor that into your decision making, so that when you do have that loss, when you do have a streak of losses, you remind yourself what your strategy is, you remind yourself what your intention is, and you remind yourself that the fact is that you're going to have these periods where losses come. If you have conviction in what you're still doing, if you have your process well thought out and tested, then things will tip in your favor eventually. So that is one of the biggest takeaways I would say that the company enforces or reinforces with the game of poker.
And they actually encourage people to play poker within the offices, I heard.
Yeah, massively so actually. So it kind of depends on what aspect of the company you're involved in, but for the sake of a massive ethos for training people when they come in the door, so they actually look to take in graduates and train them in the kind of the systems that SIG have developed over the years, and educate them to basically become good traders. So the vast majority of their traders actually have come through an educational program. It was originally called the AT Assistant Trader Program, but I believe since I actually departed, they changed the name to a Quantitative Trader Program. So very much so in that role. As you're learning to become a trader, poker is something that you are expected to play. And the key word there is expected. Like you do have to go down and play after work, play a few hands, because it's vital to your success. Like if you can play poker well and understand how it works, understand the key principles, work out the odds, be quick at working out the odds, be quick at factoring decisions, and managing your biases, managing your emotions, then you'll give yourself a massive chance of becoming a good trader. So that's definitely huge in the trading world. Outside of that, it's definitely encouraged though other departments to get involved as well. And every year the company actually has annual poker tournament with a nice prize for the winner. Yeah. So they basically get everyone across the entire organization. So I think it's about 2.5 to 2,500 people now, I think, at this stage, if not even a bit more. Again, the company's grown quite fast, so even since I left two odd years ago, I'm sure the number has gone up again. And throughout the whole all the global offices, everyone plays in regional games to begin with, and then it moves up to a final table that is held over in their headquarters over in Philadelphia. And so the top players from all around all the regional offices go over and play it out for a nice handsome reward at the end. So
sounds like a pretty good perk of the job.
Yeah, it's nice, and it also kind of lends a bit of a social side to it as well.
Absolutely.
Like those games are. They're serious because people who are competitive and sick, people want to win, but they're definitely not as serious or regimented as the training poker games that they have. So yeah.
Well, that brings us nicely around to the upcoming series that MyWallSt is curating for Noah about how poker can help you to become a better investor. In this series, you'll be able to listen to professionally read versions of articles from Bloomberg, the Irish Times and Business Insider that explain the science behind success in poker, how some of these skills can help you to become a better investor, and more on how some of the biggest names in the world of investing are honing their skills at the poker table. This series will be live in Noah next week, so make sure to download the app and check it out there. David, it was great to talk to you today. Thanks for joining me on Stock Club, and we hope to have you on again soon.
Thanks, James. Really appreciate it. Enjoyed it.
So guys, I hope you enjoyed that interview with David. Let's move on to the elevator pitch now to close out the podcast. It's fair to say that the market has been on a crazy run recently, with all three of the major US indexes touching all-time highs at the moment. A lot of this has been prompted by the incredible rise of tech companies like Zoom, as we've already talked about, and Tesla, of course, over the last few months. So my elevator pitch for you guys today is, of all the stocks that have run up crazily recently, which would you still invest in today? Emmett, let's come to you first.
Yeah, there's a lot to choose from, but I think for me, the answer is quite easy, and it's a stock that's up almost 300% on the nose from this day 12 months ago, and it's Teladoc. And I like Teladoc today more than I've ever liked it, especially in light of the Livongo acquisition, which we discussed maybe in the last podcast or the one before it. I just see this as one of the brands out there that, while is only known by a select few at the moment, I believe in the next 5 and 10 years will be known by virtually everyone in our part of the world. And when I say our part of the world, I mean English-speaking part of the world and further.
Yeah, absolutely. Another stock that really benefited from the want for people to stay apart from other people. Rory, I'll come to you next then. What company would you still invest in today?
Yeah, I'm actually going to say the one that I'm going to invest in next, the one that's definitely on my buy list, which I might do in the next day or two.
A Rory Karen exclusive. Yeah. You usually have to follow your Twitter account to get this information.
Well, you can do that too. No, the company I'm excited about buying stock in the next couple of days is a company called Sea Limited, which we discussed just last week. I was going to say Peloton, but I know you'd go mad at me if I said that. No.
The podcast will just end there.
No, Sea Limited is a company I'm admiring more and more the more I read about them. I really like the market opportunity they've got. It's an unusual mix of the gaming side and the e-commerce side, but they're using both to their advantage in order to build out the separate segments of the business. I like the CEO. I'm a big fan of that part of the world, and I think they're only going to be a much bigger company in 10 years than they are today. So even with its big run up, I'm happy to buy some shares today and wait it out.
Yeah, I'm just looking here that they've been, how much are they up this year? Up nearly 300%?
Yeah, something like that. Should have listened to Jeff earlier.
I know. So that's it from this week's Stock Club. Don't forget all the great new stuff that's coming in at MyWallSt.com. Don't forget to subscribe to Stock Club, and if you're enjoying the podcast, please leave a review or a rating for us on whatever podcasting platform you listen to us on. That's it from us here today. We'll talk to you in 2 weeks. Happy investing. This episode of Stock Club is brought to you by Hyundai. Restart your journey towards a greener world with Hyundai's next generation of zero-emission cars. Find out more about their range of electric vehicles and the savings they can bring to your company and employees at Hyundai.ie.